Next, we're going to talk about something called the efficient market hypothesis, which has to do with where stocks are, where they get their price from. Okay, so if you've ever wondered, how do we consider the value of a company? The efficient market hypothesis is the best way to think about where that value comes from. Okay, so what you need to basically recognize first and foremost here is that a stock price is always forward-looking. And what I mean by that is the price of a stock is not based on what the company has done so far. It's based on what we expect the company to do in the future. And we talked about this already with Uber, right? Uber is a company that's basically been hemorrhaging money ever since it began. But the expectation is eventually they'll become profitable, and that's why people are willing to pay for their to buy a piece of that company. Okay, so any given stock price is a depiction of the expectation. It's not a depiction of what's happened so far. And the truth can be said for the stock market as well. Just a couple weeks ago, right now it's summer 2020, we're going through the coronavirus stuff. Just a couple weeks ago, we had this job report that we had something like 13 or 14% unemployment. And the same day that they announced there was 13 or 14% unemployment, the stock market jumped up like 2%. And everybody who didn't understand how things work was like, how is this possible? The stock market is out of control. The stock market doesn't tell what's happening in the economy, blah, 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 blah. They're just misunderstanding it, okay? In the case of this specific announcement, the 14% unemployment was lower than what was expected to be announced. So basically, people were responding to things being better than what they had expected. So the stock market went up, not because the economy was good, but because there were signs that the economy was better than anticipated before. So when you look into the economy 6 months or a year from now, you might expect things to be better than we had anticipated before. So the stock market is always forward-looking. It doesn't care about what's happened in the past. It doesn't so much care about what's happened in the present. It cares most about the expectation in the future, okay? So if you see that the stock market is going up, it's not necessarily because companies are getting more profitable right now. It's because people are now expecting the economies to be, the businesses and the economy to be better in the future, okay? So in that way, the stock market evaluation is a prediction of itself. All right? It's kind of a really crucial thing to understand about the stock market. A stock market price predicts itself. So if we see that the S&P 500 is at $3,200 right now, that 3,200, comes from the expectations of what we expect the S&P 500 to be 5 years, 10 years from now. Okay? It predicts itself. And because of that, it's very hard to predict the stock market. Since this $3,200 is based on everyone's expectations, it's harder to be smarter. It's hard to be smarter than everyone else when predicting what will happen in the future. Okay? Let me try to give you some examples to explain why this is the case. And I'm going to throw one of my friends under the bus here. We've got a friend who's a dentist. He's from Zimbabwe. He's been in the U.S. for like 5 years. And, he's learning about the stock market, learning about investing. Like a lot of people that are in their 30s and late 20s, he's suddenly finding himself with some money and he's trying to figure out what to do with it. So he told me, he said, I've got a plan. I've been doing this plan every year. On June 1st, I'm going to go out and I'm going to buy a bunch of Abercrombie & Fitch stock. This was literally his plan. He bought a bunch of Abercrombie & Fitch stock on June 1st, okay? His logic was that on June 1st, let's say 2020, Abercrombie & Fitch stock will begin to rise. I hope you guys recognize this is a silly way to think about this. His logic was Abercrombie & Fitch does a lot better in the summer. That's when they have a lot of their sales. So in the summer, Abercrombie & Fitch is going to make more money. And if I'm a stockholder, I'll make more money too, right? It's kind of misunderstanding the role of a stockholder. If I own a tiny little business, if I own a little bar in downtown Milledgeville, I'm probably going to make a lot of money around graduation, right? I'm probably going to make a lot of money around graduation. I'm probably going to make a lot of money around, the Sweetwater Festival, right? There's going to be these, or Deep South, whatever we call it. When I was a student, we called it the Sweetwater Festival. Now it's like, Deep South Festival or something like that. So, the logic here is, my friend who's a dentist was sort of thinking about this the way a private business would think about things, which is profits are going to go up when business is good, profits are going to go down when business is bad. But the problem is the stock market valuation is based on expectations, okay? What causes stocks to go up is when people buy them. And what causes prices of stocks to go down is when people sell them, okay? So basically, there's no way he's going to be able to use this logic because everyone else can use this logic as well, okay? What he was basically anticipating is that over time, this stock on June 1st is going to suddenly go up in the summer and then level back out as we reach the fall. All right, this is sort of what he was expecting, right? The stock will be low, and then the summer hits, it'll go up because the company's earning more profits, and then it'll level back out. All right, and if you're thinking about a private business, maybe this would be what it looks like, right? Maybe for a bar, maybe this is the graduation period, right? Where you're making more profit. But let's think about stocks, okay? Let's think about stocks. If we expect this company to suddenly become more profitable in the summer, think about this, okay? You might think, well, I would like to buy the stock on June 1st. The problem is if everyone had this mentality, if everyone said, look, the stock market, Abercrombie & Fitch is going to do well starting June 1st, then everyone would go buy on June 1st, and that indeed would drive prices up, all right? So prices would go up on June 1st, okay? So what would you want to do as an investor? If you knew that everyone was going to be buying Abercrombie & Fitch on June 1st, when would you want to buy it? You'd really like to buy it the day before, right? When everyone buys it on June 1st, that's going to push the price up. So you want to buy it the day before so you get a low price, and then you get to enjoy that increase. So the goal here would be to buy on May 30th, okay? The problem is, people aren't stupid, so they're going to have the same realization as you. If they want to own the stock when it starts to go up on June 1st, they want to go ahead and buy it on May 30th, all right? Of course, the problem is if everybody is now buying it on May 30th, you would then want to buy it on May 29th, and hopefully you can see where we're going with this, okay? If people just think this company's going to do well in the summer, so I need to buy it right before the summer, the thing is going to unravel, okay? If I want to buy this before it sees the spike, I need to buy it further and further into the present, okay? So the bottom line is, if you look at these companies, they don't see these spikes in the summer. It doesn't do like this for Abercrombie & Fitch, where it's level and then jumps in the summer when profits are higher. Instead, the fact that the summer is going to be more profitable is already priced into the value always. Okay? You'll see this term, priced in. It's not really a technical term, but if you start talking to people who understand personal finance, they're going to surely use this term. Okay? Priced in basically just suggests the stock prices already include expectations of future profits. So what that means is, if the stock market price of Abercrombie & Fitch is $40.50 in January, don't expect that price to go up in the summer, because this price is already based on the expectation that profits will be higher in the summer. You see? People who own Abercrombie & Fitch in January are owning it because they know about the profits that are expected to come in the summer. So if you look at Abercrombie & Fitch's stock over time, it's not going to jump in the summer. It's just going to sort of gradually grow over time with these sort of unanticipated increases and decreases as we go through the future. Okay? If you look at the U.S. stock market over time, same deal, right? When do companies normally earn their most profits in the U.S.? A lot of times people mention Black Friday, right? The day after Thanksgiving. Black Friday up until Christmas a lot of companies make a significant amount of their revenues during that window. So you might think, well, why don't I just invest right before Black Friday and make money? Again, the logic there is not sound. Everyone knows Black Friday is coming. So the stock market has already priced in Black Friday because everyone knows it's happening anyway. Okay? If you can anticipate something, the price will already include that anticipation. All right? So, to sort of make this more formal, let me give you the term now that's really important. Something called the efficient market hypothesis. And this is the concept that the stock market is unpredictable. Because the share prices already price in all knowable info. It's the concept that the stock market is unpredictable because prices already price in all knowable info. All right. What we mean by this is, if we look at the value of any company right now, if we look at its stock market price, that price is a balance of all investors, right? If people expect that company to do well, they're going to buy it and drive up the price. If people think it's going to do poorly, they're going to sell it and drive down the price. So you can sort of think of it this way. You know, if this is a scale here, I'm not good at drawing, but I'm going to try anyway. So if this is a little scale here, this is our buyers, and this is our sellers. The price of any given stock is a perfect balance between the buyers and the sellers. Again, if stock market traders think a stock is going to go up, they're going to buy it. And if they think it's going to go down, it's going to sell. So whatever a price is right now, you know, if some firm is trading at $112, what that means is we've perfectly balanced the buyers and the sellers at that price, right? If buyers thought it was going to go up, they'd buy it, driving the price up. If sellers thought it was going to go down, they'd sell, driving the price down. So that price represents the collective wisdom of billions of investors. That's sort of the beautiful thing about the stock market, is billions, literally billions of people invest in the U.S. stock market. And the price reflects the information that these billions of investors have. So if you think you're going to buy this company and make more profits, if you think, oh, I think this company is going to go up in value, what you're really saying is, I think I'm smarter than the billion investors that have driven this price to this level. The stock market is incredibly unpredictable because so many people are trying to predict it, you see. It's really an amazingly eloquent realization, all right? So what this means is it doesn't really matter if you're good or bad at picking stocks. In fact, there's no such thing as being good or bad at picking stocks. And the data really reveal that. It's impossible, or maybe just close to impossible, to be better than the market, okay? So we talked about in the past, the interest rate you can expect in the market is 10%. If you invest in stocks over the long run, you might expect to earn 10%. The problem is, I run into students all the time who think they can do better than that. I know they think they can do better than that because they come to me and they ask for advice. What company should I buy? My answer is, whatever you want to buy, right? Because the prices already include all the information that we know about these companies. This $112 stock price is based on everything you could possibly know about the company. So if you're some Georgia College student who thinks you know more than these billion peoples, why would you think that, right? I have students who, you know, they basically gamble in the stock market. They do options trading and all kind of crazy stuff. Again, the logic there is that they think they can beat the market. Why would you be able to beat the market? Why would you be smarter than other people? It just doesn't really make sense. So you can basically just arbitrarily pick stocks and do just as well as this 10%. Well, you need to figure out logistically, though, how to do that. The key realization thus far is that the market is unpredictable, and we get that from the efficient market hypothesis. And if you're not sold on the efficient market hypothesis, I'm going to give you some more information I think that'll make you better understand why this is a good depiction of reality. The stock market is unpredictable because everything you could predict is already baked into the price of any individual stock. So what makes the stocks go up or down is when something unexpected happens. The coronavirus hits, the S&P 500 loses about 35% of its value. We couldn't really predict that, you see, and that's why you see such a big drop. If you could have somehow predicted that the coronavirus is going to happen, you could have made a lot of money off of that. But the problem is you couldn't. Because if you could have predicted it, other people could have too, and the price would have already reflected that the coronavirus was coming. So, a related topic is this idea of active versus passive management. This has to do with how you are picking stocks. All right? Active versus passive management. The goal of any type of investment really is to invest at the highest possible interest rate but minimize risk. So as I mentioned before, the stock market on average earns about 10% annually. So at least that's how it's been historically. So my goal would be, if I'm going to invest in the stock market, I want to get that 10% return, and I want to invest with as little risk as possible, okay? Obviously, that means that you want to hold for many years, all the stuff that we've already been talking about. All right, you want to hold for many years because over the long run, stocks are less risky. It's not that stocks become less risky over time. It's just that they tend to go up and down. And so if you can buy for a long period of time, you'll get some ups and some downs. They'll kind of average themselves out over time. The second thing you need to do is hold as many stocks as possible. And this is kind of what we're going to be talking about right now, is just hold as many stocks as possible. This logistically becomes a problem, all right? When it comes to buying stock, you might just be thinking, I'm going to go online and buy some Amazon stock. But if you go online and buy Amazon stock only, that is unnecessarily risky. And what the efficient market hypothesis suggests is that buying just Amazon is not any better or worse than buying any other company. After all, if Amazon is going to do really well in the future, the price will already be very high to accommodate that expected increase, right? Again, if a company is expected to do well into the future, its stock price is already going to be high because of that expectation. So you might just think, just invest in good companies, but the problem is everyone knows what companies are good, and they've already invested in them, driving up the price. So as a result, it's not about picking and choosing stocks. It's about just investing in all of the stocks. And this is certainly impractical to do. If you're just going to go out and buy individual stocks, there's no way you're going to be able to properly diversify, okay? It used to be you got charged fees to buy stocks, and that's kind of gone away in the last couple of years. But still, nonetheless, there's over 3,000 just American corporations you can invest in. What are you going to do? You're going to go out and buy shares of 3,000 companies? It's going to be really hard to do. It's going to take a tremendous amount of money because you usually have to buy at least one share of each company in order to do that. So it's not practical, okay? So as a result, you're going to have to find a fund that captures it, okay? And so we're going to be talking about here an introduction now to financial instruments. Lots of ways to define this term financial instruments, but the way I'm going to use it now, these are assets that contain many other assets. So they're assets that basically package together lots of other assets, okay? So if I just buy Amazon stock, that's not going to be usually a good way to invest my money. Instead, I would like to buy a bunch of stocks. And so there's various financial instruments that do this, okay? One that you probably heard of is a mutual fund. A mutual fund is a collection of assets tied together. It's really just a specific type of financial instrument. Mutual fund, again, probably something you've heard of. Mutual fund is going to contain a lot of different assets, right? So I could go online right now and buy a mutual fund that literally contains every American publicly traded company. So rather than trying to go out and buy, all these different companies, I can just buy one thing and it contains all of those companies, all right? Mutual funds can be really good, okay? But typically they are actively managed, which we will need to define here in just a bit. But I basically just want to first give you a little bit of terminology to help you understand what we're talking about here, all right? So mutual funds just contain a bunch of stuff. Index funds are basically the same thing, also a collection of assets, with the key difference typically between these two being that index funds are passively managed. I'm going to formally define these in a second, but usually the difference between mutual funds and index funds is in mutual funds, you have someone picking and choosing the stocks, okay? So there's literally a person or some people that are going in and saying, look, let's add more Amazon to this fund because we think Amazon is going to do really well. That's called active management because they are actively deciding what is in the fund, all right? Passive funds, index funds are usually passively managed, and what that means is there isn't anyone picking and choosing what's in the fund. Instead, the fund is based on rules. So, for example, there's a really famous group of index funds that basically just track the S&P 500. Remember, the S&P 500 is the 500 biggest companies. It's value-weighted index. So you can just invest in the S&P 500. That's passively managed because the person running the fund is not choosing what's in the S&P 500. They're not going in and saying, let's buy more Amazon. No, they're just buying the assets that are already in the S&P 500 and just following a predefined rule. Invest in the S&P 500. There's no picking and choosing there, okay? So let's formally define those now. These index funds, these mutual funds, they contain stocks. They might also contain bonds. They might contain one or the other. There's just thousands and thousands of different examples of these. And basically, it can fit whatever goal you have. If you're close to retirement, there's probably an index fund or mutual fund that will work for you. If you're far away from retirement, there's going to be a different fund set up based on your risk tolerance and what you're really trying to accomplish. These actively managed funds, again, means that someone is picking and choosing. All right, and active managed funds means that there's a fund manager that picks what assets are included. This can be very aggressive or it can be kind of unaggressive. So an aggressive mutual fund would be like the example I gave before, where there's an individual manager that says, I think Amazon is going to do well, so we're going to triple the amount of Amazon stock that we have in our mutual fund. It can be non-aggressive too. A mutual fund could be set up where it's actively managed to pick tech stocks. And so this actively managed fund can basically say, we have the ability to choose what tech stocks are included. That might not be as aggressive because they may just be searching for the companies that fit what they want, but they're not so much gambling. They're not so much saying, I think this one stock is going to do well. On the contrary, passive management, which I suspect is going to fit a lot of your investment profiles based on what you're going to learn in this class if you don't know this already. Passive management means the fund basically follows rules to determine what's included. So the fund follows rules to determine what's included in the fund. And you're going to have a manager, right? You're going to have people that have to run the fund because there are still things that need to be done. So for example, if I invest $10,000 into a passively managed fund, the fund manager has now got $10,000. They have to figure out a way to get that invested. Right? Logistically, there's work that has to be done. But they're not picking and choosing what's in the fund. They're just following rules. So as I said before, they might just invest in the S&P 500. An S&P 500 index fund would just invest in the S&P 500. It would invest more in the companies that are bigger because the S&P 500 is value weighted, right? It's based on market cap. The only problems that the fund manager has here is just to make sure they're tracking the fund. The S&P 500 will kick companies out when they're no longer in the top 500. Well, that means that the fund manager's got to sell all the stocks for that company, and they got to buy whatever new company comes in. So there's still work to be done, but it's just basically fulfilling these sort of basic requirements of the fund. They're not going out picking and choosing. They're just doing the legwork to give you the fund that you want, right? Another good example is there are total stock market funds. These are hard to beat, in my opinion, if you're basically just wanting to invest in the stock market. You can basically invest in all American corporations in just one fund, and it's passively managed in the sense that no one's picking and choosing what's in it. Generally, these are going to be value weighted, again, which means the biggest companies are going to be the biggest share in your fund, which conceptually makes sense. Biggest companies are more important to the economy. So, again, the difference between these types of funds is here you've got people picking and choosing what's in the fund. Here, it's just based on rules, all right? Now, which of these funds do you think would do better? Based on what we know about the efficient market hypothesis, would you be better off having somebody picking and choosing stocks, or would you be better off just sort of randomly, arbitrarily picking stocks like passive managed funds do? You might be tempted to say it really doesn't matter. The efficient market hypothesis basically suggests that it doesn't matter which of these you're going to do. But it turns out that passive management historically has won out over active management. And we're going to have to explain why that's the case. Really hope you're paying attention because this is sort of, really crucial details to investing. As soon as a student comes to me and they say, "What stock do you think I should pick?" I immediately know that person doesn't know what they're doing, to be honest. Because once you do some research, once you look into the data, you realize you don't need to try to go out and pick individual stocks. And secondly, you don't need a fund manager to go out and pick individual stocks because no one is good at beating the market. You might be tempted to say, well, Warren Buffett has beaten the market. Well, lately he hasn't. And when you ask Warren Buffett how to invest, you know what he says to do? Just invest in the total stock market. He himself believes in passively managed funds. I'll show you guys an example, maybe in the next video, of a contest that Warren Buffett was in that he won just by using passive management. So let's talk about some problems with actively managed funds. Remember, active management means you have somebody picking and choosing the stocks. The corollary, the other option, would be passive management, where you have funds that are just based on rules. The biggest problem with actively managed funds is actively managed funds charge high fees. And man, this is such an important aspect of this class, so please pay attention right now. We're introducing a concept that you're going to really have to think about a lot for the rest of this class and throughout your investing career, okay? Actively managed funds charge high fees. The most common fee that you're going to see is something called an expense ratio. This is a fee that's charged by a fund that's expressed as a percent of your overall investment. A fee charged by a fund that's expressed as an overall percent of your investment. So you might start looking at some funds later on in today's lectures. I'm going to show you literally some funds and show you the expense ratios that they have. But just to give you an example, you might see a fund that has a 1% expense ratio. A 1% expense ratio means for every dollar you invest in the fund, they're going to take out 1 cent every year. Okay? So 1% of your funds will go to the fund manager. Will leave your account, right? You don't really care where it's going, but it's going to the person, typically, that's picking and choosing the stocks that are in the fund. You know, these people are highly paid. These people who do who manage these funds, they're paid a lot, and that pay comes from your expenses, the expense ratio that you're putting in. And that 1%, it doesn't sound like a lot. I counsel people about their personal financial goals and what they should do, and I hear this a lot. 1% didn't seem like a lot of money to me. Well, the problem is the stock market returns on average 10%. Okay? So if the stock market on average returns 10%, but you're giving 1% away to the manager, right? Think about this. If the stock market returns 10% and 1% of your money is going to the fund manager, then basically 10% of gains will be lost. I hope you followed that math. Again, if the market returns 10% on average, but you're losing 1% to the fund manager, you're giving up 10% of the gains. And when you start thinking about lots of money, when you start thinking about big piles of money, that 10% ends up being a big deal. Because not only are you losing 1% of your fund, but you're losing the interest you would have earned off of that fund. Okay? I'll show you the math here in a second. You'll see the numbers can be really big. All right? So for active management, this is what you might see, like a 1% expense ratio. It's pretty common. In fact, back in the day, people used to say 1% is a good deal. Nowadays, we have way more options. We've had this race to the bottom being 0% expense ratios. Funds have been driven down to the level now where you can get a passively managed fund for almost free. So a pretty typical expense ratio now on a passive fund is like 0.05%. 0.05%. Let me do the math here. This means that if you put $100 into this fund, you'll lose 5/100ths of a cent. So another way of saying that is if you put $10,000 into this fund, you lose, I'm trying to do the math in my head here. Let me do it real quick. Just to show how little this is. Yeah, that's what I was thinking. If you put $10,000 into this account, you're going to lose $5 per year effectively. Now, the fund is going to grow, and this will grow as well, but you can see this is pretty small, all right? So let's do the math, all right? Let's think about what this means, and let me take one quick step back. If you're wondering why pay any fund, there's still work to be done, right? If you put $10,000 into a passively managed fund, you might have to call customer service up and say, I'm having trouble withdrawing funds. They got to pay that worker, right? Somebody's still got to figure out a way to buy all these stocks. You got to pay that worker, all right? So there's still work that needs to be done and things you need to be paying for. This is a bargain, I think, right? This is a very small fee. So let's do some math just to understand how different this can be. So let's suppose that active and passive funds both earn 10% returns, but expense ratios are different. Use those same values that we had before. Let's say that active has an expense ratio of 1% and passive has an expense ratio of 0.05%. And let's say that you're going to invest $100,000 for 30 years, and let's just use annual compounding interest. By the way, that 10% that we quote for being the normal return, that is based on annually compounding interest. So it's practical for us to use that in our calculations. So the math here, you see, is for this actively managed fund, and you're going to need to get very comfortable with this type of change, all right? The math here is pretty simple. The change here is a quick fix. All right, we can use our future value formula. The $100,000 is the present value, okay? And where that expense ratio comes in is I'm just going to take out 1% from the return, okay? If I really needed to, I could prove to you mathematically that this is a good way to do this, but it's a nice simple fix. If you're earning 10% returns in the market, all right, but the fund is taking away 1% of your total funds, then effectively it's like you're getting a 9% return, okay? So just subtract the expense ratio from the interest rate to get your adjusted interest rate, okay? So we raise that to 30 years, and the future value here comes out to this, okay? By the way, which is a lot of money. So basically, if you could get normal returns in the market, this is how much you would need to invest to reach that amount. That's the power of compounding interest. All right, so now let's try it here with a 0.05% expense ratio. And that's what you get. This is a 9.95% return, 10% return, but you lose 0.05% to the fund. All right, so that would be our return that we received there. For 30 years, you get a future value of that, 1.7 million. Now compare, just compare between these two values here. That little difference of 1% versus 0.05% ends up being hundreds of thousands of dollars in lost gains, okay? The difference between these two, the delta between these two, is about $394,000. So if you're investing and you just randomly decide that you're going to put your money into active funds, you can see what a huge, colossal mistake this could be. And I'm telling you guys, because I talk to people all the time that are investing, this is still more common. Active management is still a bit more common than passive management in terms of the types of investments people do. So people are paying these fees, okay? The only way the actively managed fund is going to beat the passively managed fund is if they figure out a way to earn a higher interest rate. But notice they've got to earn a much higher interest rate. If they are able to earn 0.5% more than passive management, that is not going to be enough to overcome this roughly 1% difference in fees. So actively managed funds are going to have to do a lot better than passively managed funds. And here is the real disaster. Passively managed funds do better than actively managed funds even when you ignore the expense ratio. Historically, actively managed funds have done worse than passively managed funds even after you ignore the fees. So in this case, not only is it going to cost you $394,000, but on average, it's going to cost you more than this because you're not going to be able to get that 10% annual return. And if you think I'm just making this up, I'm not. This is based on actual data from these funds. You can go back and look at these funds. There's tons of papers on it. Actively managed funds, sometimes they do better than passive, but it's on a very small degree. All right? Between 1976 and 2006, which is a 30-year period, which, by the way, is how you want to think about investing, right? Don't think about investing over a 6-month period. Think about it over a 30-year period. Over this 30-year period, there's a paper. Went in and looked at all of the different passively managed funds and all the differently actively managed funds. Chose some of the biggest ones. And what they found is 1% of actively managed funds beats their passive counterparts. 1%. And you could basically assume that, a lot of that 1% is just luck. Because again, think about the efficient market hypothesis. The efficient market hypothesis suggests that it's very difficult to pick stocks because stocks are based on everyone's expectations. The current value of any given stock is based on the collective wisdom of 1 billion people. And what the actively managed funds are trying to do is beat the collective wisdom of 1 billion people. And it turns out that those billion people are a lot of people like themselves, right? If most of the market is actively managed, then most of the transactions between purchases and sellers are one actively managed group buying from another actively managed group. They can't both be right, right? If you're investing, let me be very clear. Let me say this again. If one actively managed fund buys a stock, they're probably buying it from another actively managed fund. One of these people must be making a bad decision if one of them is making a good decision. So if you combine those two together, actively managed funds can't outpace the market because they're the ones determining what the market is. If I buy passively managed funds, the prices of the market is already based on what these people are doing. So you got all these people going out scrambling, making purchases, sales and everything. These people are just buying and holding and not really caring what they're buying because they know that these people are doing tons of trades anyway that are ensuring that prices are where they need to be. So why do these funds do worse? Well, one, because of fees, right? If they're charging 1% fees, that's going to be very hard to beat the market. And that's driving a big reason why passive management is so much better. But it's not the only reason. So in regards to the problems with active management, one, we have fees. All right, we mentioned expense ratios. Be prepared to discuss this. That's not the only type of fee that you might see. You also might see front-end load fees or back-end load fees. I want to explain how these work really quickly as well. All right, we're still going to be using our present value calculations to do this stuff. It's just another extension of that. A front-end load fee is basically a fee to purchase. And a back-end load fee is a fee to sell. So if you're ever investing in some sort of actively managed fund, they may charge you a fee up front or a fee on the back end. Passively managed funds could do this too. I just don't see it very often. Passively managed funds are usually, they just have an expense ratio and no other fee. These companies want to make money off of you, and ideally they'd like you to not know much, right? Because if you don't know much, you're going to call them up and say, I need to invest, I don't know what I'm doing. They're going to sell you something with load fees and a high expense ratio, okay? So just to go back to that last example we just had, if you have $100,000 invested for 30 years, and let's say that there is a 1% front-end load fee, all that would mean is you don't invest $100,000, you end up investing $99,000. They're going to take 1% of your funds as soon as you buy that fund, all right, as soon as you invest in that instrument. So you're only going to end up with $99,000 invested, right? And all of these fees and expenses and everything, they happen regardless of whether your fund is doing well or not. So to be clear, if the stock market returns a negative 15% for a year, you're still going to be paying the expense ratio and any of these other fees. They are always going to be paid. So that would be for a front-end load fee. For a back-end load fee, if I look back to my math here, so if I look back to my math here, we took this $100,000 and we invested it. And if I just use my answer that I had before, this is what you ended up with, okay? And let's say that you have this much money in your account, right? You've paid that 1% expense ratio in the previous question, and this is how much money is in your account. If you want to sell this account, they're going to charge you 1% to do that. So 1% of this would be taken away. So effectively, you'd have a fee of 1% of that, which I guess would be this amount here. Doing the math there in my head, right? Just 1% of this value here, okay? So you're going to pay that huge fee due to that back-end load fee. Load fees are not crazy common, but again, if you don't know what you're doing, these companies that manage assets are going to prey on you, right? You're going to call them up and say, I'd like to invest. They have a huge incentive to sell you something with a very high fee, and that's probably what they're going to do. I had somebody come to me and they were like, I'd like to improve my personal finance strategy. They had called up a company to do investments for them, and I'm going to show you guys an actual picture of the stock they had, or the fund that they had. But they had a back-end load fee of 5.75% for their fund. So you can imagine, what a huge expense that would be. These companies have to charge fees because they have employees, but they're going to charge as much as they possibly can, especially to people who don't really know what they're doing. So if you decide you're going to seek financial advice, if you're going to hire a financial advisor or a financial planner or something, you still have to know enough so that they don't screw you over, to be honest. Okay, and we'll talk more about how to ensure that in the future.